We're back with part 2 of this presentation, and we're going to jump right back into it where we left off the first video in just a second. But I first just want to say a quick thank you and hello to everyone who watched the first video and responded so favorably. And I just so appreciate all the feedback. Definitely motivated me to get this one out earlier than I was expecting to. So I hope this one has as much value to you as the first one, if not more. And if not, well, I tried my best. So here we go. Quick disclaimer, this is not financial advice. Everything discussed in this presentation is for educational purposes only. So what are the next 2 scenarios? Well, let me first start off by saying scenario 3 is relatively easy, and you probably already know it or have seen it before, but we are going to go in depth on it. Scenario 4 is possibly the most advanced out of the 4 scenarios, not because it's overly complicated or confusing. It really isn't at all, but just because of how it blends in with the DR, it might seem a bit contradictory. And for that reason, it might even seem a little controversial or, just more difficult to embrace as opposed to the other 3 scenarios. I do think there is a lot of value to it though. So let's look at what scenario 3 is. Scenario 3 is a 5-minute swing high low raid with a low time frame confirmation if necessary. Sometimes you need it, sometimes you don't. Let's take a look at the diagram. This is just one variation of it. We get a close above the IDR high. We can also get a close above the DR high. Price retraces to a swing low within the range. This swing low is at the midpoint of the range. The swing low could be near the bottom of the range, near the DR low or IDR low, or somewhere in between. There can be multiple lows in this range, and we don't know which one is going to be the one that it takes out, although we do have some clues that we could look at when you look at some of the examples. And then once price comes and taps into this low, probes below it, that is when we can, if we want to, zoom in on a lower time frame for an entry. And for entries, I'm talking about obviously an ICT style entry, ones discussed in his 2022 YouTube mentorship. So this is one variation of this scenario. And like I said, you've seen it before. In fact, you've probably seen it in the original video from TheMas7er, because this is one such example where he shows you where there's a swing low created after confirmation or IDR confirmation. And we have a sweep and a fair value gap created. So in this example, you didn't have to go to a lower time frame. Now there are other variations of this, such as this, where the low gets rated above the range. So we've already had a confirmed break higher, suggesting this is our low. We have a swing low here that price does not ever come back to. And instead, we're beginning to trend perhaps. And then we have just a recent swing low that gets tapped into. Maybe it's close to the top of the range. Maybe it's further away. You just have some risk that the further away you go, more of the move has already taken place. And so that could affect where you might want to take profits, for example. And then here, same thing. We would look in on the lower time frame, if necessary, to pinpoint and time an entry. And our stop loss would probably go, somewhere below this low. And the same is true for short scenarios as well. So with that said, let's get to some examples. Here we have US 500 on a 5-minute chart. We have our DR low and our DR high, and price is broken out, leaving a swing low at around the midpoint. Keep in mind, we also have a fair value gap right here. Maybe we draw out a line like this, set an alert, and then go about our day. An hour later, price comes back down, retraces to the low, sweeps the level, sends off our notification, and we come to the chart and we see that we have a nice long wick with a bullish close. Do we buy right here? Well, you could maybe, if that's what you want to test, and then maybe put your stop below here. But what I would like to do in a situation like this is validate it using the lower time frame. Here on the 3-minute chart, we can see things a little bit more clearly. You can see our raid of the swing low, then price, after forming a bit of a consolidation, pushes up, clearing these highs, leaving behind a fair value gap. This is where we can enter. We could set our stop below this low, or maybe below this candle. Where do we target? Well, we have these relative equal highs. We could take a partial. We could use our extensions, which is just a fib tool. I'm not using any fancy indicator in this video. Just a fib tool going from the IDR high to IDR low. we can aim for this target here, also noticing that we have this 3,900 big figure level, and this is about 10 points above it. We play it forward and we can see price goes right to target. Now, if we look a little bit closer, we can see that price worked this fair value gap a few times, but do you see that we have the exact same setup happening here again on the 3-minute chart, where we have these lows put in, price probes below it, spikes higher, takes out this short-term high, leaves a little gap. This could have been another entry if you missed the first one, or if you wanted to see a little bit more confirmation. Next example, US 100 5-minute chart. Here we get a close above the IDR high, suggesting that the low of the day might be in. We can take a look within this range and see we have a swing low here and a swing low here. We can mark them out and wait for price to retrace. Price comes back to those lows a little bit later, and then we can look on the lower time frame to see if there's any reason to want to be a buyer. Now, what do you notice about the lower time frame? Here, when price takes out this first low, we don't really get any type of a setup. There's no displacement. In fact, all we do is kind of chop around and then drop lower, taking out the bottom low. After which point, price forms this short-term high, comes back down, a higher low, then aggressively comes up, taking out this high, leaving behind this gap here and this gap here. Price then continues up, clears out this high. We could begin to set an order at any number of levels. We could choose the higher gap if we want to increase the chances of getting tagged into the trade. We could pull a fib from low to high and enter somewhere around the 50% or lower. We could look at the 62% fib and see that it's lined up with the lower gap. We could look at the 79 and say that it's lined up with the IDR low. Obviously, this would be fantastic risk to reward, but a greater chance of price not making its way down there. For targets, we can see that we have this imbalance right here. We have the IDR high, and maybe we are feeling bullish for whatever reason on the day, and we aim for this high. As you can see, price tags us in and then rallies to new highs on the day. Next example, also on the US 100 5-minute chart. Here we have a confirmed break below the DR low. The reason why I wanted to show this example is because sometimes you just have to wait for price action to develop a little bit. Here you can see price does form a high right at the midpoint of the DR range. I think this is interesting because I know some people have just experimented with taking a short, let's say right at the midpoint every time and putting your stop above the high. I think that can work, especially when you have this sort of structure right here, which is we have this order block that took out a high and a displacement lower. I think you could definitely do that in this type of situation, but sometimes what you have to be aware of is that if you're one that moves your stop loss pretty quick, you get tagged in, let's say right here, you see price move down to the DR low, you might think, okay, I'm going to move my stop to break even. Then what happens? Price comes back up and takes you out of the trade prematurely. Now, this does look pretty strong, the way price came up with this one solid candle. It's not a conventional sweep. Typically, I like to see a big wick through the level, but it doesn't always have to look that way. However, this is a perfect reason to jump now to the lower time frame to see if there's a confirmation entry. First, take note that price has rallied above this short-term high and this short-term high and filled in this gap on the 1-minute chart. Breaks this low and leaves a little tiny gap here. Obviously, it's subtle. Maybe you don't want to put your stop right here. Maybe you want to put it above the IDR or the DR or that order block that I showed you earlier on the 5-minute chart. Either way, this would be a good time to set your limit. You get tagged in and the low gets met. In fact, this trade went on to reach all of the extension targets below. Moving on, ES 5-minute chart. This was pretty recent. In this example, we can see that price has broken outside of the DR range. We are confirmed bullish, with this low being very unlikely to be hit. We have several swing lows in this range that price never comes back to. Do we just do nothing? Well, maybe if that's your setup, you could just always wait for a setup that comes back into the range, or you can see what develops afterwards. Here we have a swing low formed and price comes down and takes out this low. Also want to point out that we have this sort of retail pattern, this ascending wedge, and we see this break of the ascending wedge inducing people to short. And look where you'd be shorting right into this swing low, which may or may not be a good idea. Let's look at the lower time frame and see what shows up. Here we can see on the 1 minute chart that there is a balanced price range. Balanced price range, as you know, are two overlapping fair value gaps like this, where price has come down and taken out some sell side liquidity. When this happens, we get a push back up with this fair value gap. Here's where you could put your order, and stop could go below this low with a little room to breathe. Notice that we don't have a new short-term high here. Sometimes you will get it with the balanced price range, sometimes you won't. That's a criteria you might have to test for yourself to see what you prefer. In this example, maybe you just go for 2R. You don't want to push it. Price is already extended out of the DR range. Or maybe you take a look at the 1 hour and see that that 5 minute low that got hit, that got swept, also happened to be a 1 hour fair value gap. And you say, okay, the higher time frame is also very much supporting a move higher. I'm going to let it run. And if you did, you would have been pretty happy that day. Also, take a look at this. If you wanted to wait for a market structure break, you had one here. Next example, ES 5 minute chart. And on high impact news days, the DR is less likely to work, but let's take a look at what played out anyway. Here we have a break of the low. You can see price comes back, taps the IDR low a few times, forms some equal highs, and then price comes up and takes those short-term highs. At which point we zoom in to the 1 minute chart, and we can see that we have this candle that took out the liquidity here. We have the displacement back down, leaving this little gap. Entry goes here, stop could go here. Price tags us in and drops off, filling the gap created from the high impact news. Next example, US 30 5 minute chart. Here we have the IDR high broken with one candle. Then we get a second candle close above the IDR high. Something to think about. Maybe the number of candles might be important to you. Price then comes down, takes the swing low at the midpoint of the DR. Also, what do we see? We see this fair value gap. We see these down close candles, these bullish order blocks. What did that order block do? It took out this swing low, filled in some of this gap. So we have a lot of evidence that this might be a good trade to be involved in. Jumping down to the 1 minute chart, once again, we can see our balanced price range, the overlapping fair value gaps. We can set our entry and we get tagged in. And after a long period of sideways consolidation, price rallies for the rest of the day. Looking at the 5 minute chart, do you notice something else? We also have the same setup happening again. We form a short-term low, price comes down, takes the lows, shoots up, creating this gap. That could have been another entry. Maybe you want to look for opportunities to add to winners. That's where you could do it. Now, did that chart look familiar to you? If so, it's because you've already seen it. You've already seen it in the first video. The first video because it was also a scenario 1 where we had a clean break and retest on a 15-minute fair value gap right at the DR high. Can there be multiple scenarios playing out during the same session? Yes, there can, and that's the next point I want to get to. Here we have both scenario 1 and scenario 3. So scenario 3 could have gotten you in here. Scenario 1 could have gotten you in here. And here, scenario 3 could have confirmed scenario 1 right here. And then scenario 3 could have given you another entry right here. So as I said, there can be multiple scenarios playing out simultaneously. Sometimes the scenarios are in alignment. Other times they are in opposition. More on this in a minute. Here we have US 100 on the 5 minute chart. We have the break of the DR high, and we can mark out swing lows within the range. We can also maybe look and see that price has hit some sell side liquidity and makes sense to see a push up. Back to the 5 minute chart, and price retraces and tags the level. We look at the 1 minute for entry, we see our balanced price range, and we set maybe our order at the 62% fib this time, and we expect it to win because it always wins, except it doesn't always win. Sometimes you get taken out if your stop is too tight. Now I want to show you this chart. This is how the rest of the day played out, and the reason why I want to talk about it is, let's say you didn't get stopped out right here. Maybe you had your stop a little bit below this wick. This is a fine trade. If you didn't get taken out here, this was a very tradable bounce, as you might say. Maybe you took a partial, but of course it didn't make a new high and eventually came down and took out your stop eventually. totally fine. But what if there was another way to trade this day? What if there was another scenario that could have helped you see this as a potential short? Or even if you didn't want to short this because you did get the DR high break, maybe it could inform your decision making on where you want to take profits on the long. Or maybe you don't want to be buying at all because of what I'm about to show you. This same trading day can also be framed like this. What I'm about to propose to you is the fourth scenario. Let's play out this day from a slightly different perspective. Here we have a break of the DR high, one solid candle. We get a little bit of a consolidation sideways, another spike up of this high into this hourly and 15-minute fair value gap, which I'll show you in just a second. Price then reclaims inside the DR, takes out some swing lows, comes back up, tests the DR high again, and this consolidation, and then sells off to the IDR low. Notice that we still did not make a new low on the day. So the rule on the stat sheet would still show that this was a day in which the rule was still valid. We broke out, closed above the high, but this low never got violated. What can we do with that information? Would you really want to be selling on a day where the DR breaks the high? Maybe, maybe not. If we zoom out now onto the 15-minute chart, there you can see it again. There's the gap on the 15-minute chart. And maybe you zoom out a little bit more on the 1 hour, and you can see that we have clear bearish order flow, strong momentum to the downside. And if maybe we zoom out even more, we could see that we've been trending down for quite a bit now. And now you ask yourself, do I really even want to be buying that scenario 3? And so with that said, this is my introduction to the fourth scenario, the break and reclaim of the DR range with higher time frame PD array. It looks something like this. Right off the bat, does this look familiar? Doesn't this scenario 4 resemble a market maker sell model? Maybe we have a consolidation here before a move up, a reaccumulation, another move up, a smart money reversal with a low risk sell, distribution, redistribution, and sells off towards the low. Now, this might make you a little uncomfortable if you've been studying the DR. It might just not click with your brain to think, why would I want to short on days where we've broken the DR high? And that's fine. I do want to point out, though, this isn't as controversial as it may first appear. In fact, the master even references it in his second video. You can see right here, he talks about, in this example, how price has been overextended and you could possibly short back down into the range. Now, as he pointed out, you probably would not want to hold till the low because we know that 80 to 90% of the time, this low is not going to be touched. Let's go back to this example. I showed this chart in the first video, and I basically posed the question, is there a way to justify using the DR and using what we know about ICT to justify being a buyer, maybe here or here, targeting, the midpoint or this up close candle? We identified there really isn't much in terms of a selling opportunity on this particular day. Is there a scenario 4 at play? And I would say there is. If we take a look at the daily chart, we can see that the DR low that was broken occurred right at this down close candle. I've drawn out the level of this daily order block. Also take note that the general order flow on the daily chart is bullish. Now let's hop down to the 60-minute chart. This is that daily order block level. We can see just beneath that, we have a 1 hour fair value gap. And I'm also indicating there a sell side liquidity on the lower time frame right here. We have a swing low on the 5-minute chart. Zoomed out a bit, you can see we have this sell side liquidity taken inside this 1 hour order block, just below this daily order block level. So we know with the DR low broken, it's not as likely to take out the high just by the statistics. But does that mean we cannot buy at all? Well, I'm going to show a framework where maybe you can if you want to. Or maybe, like I said, this is a day where you don't want to take a sell because you see a scenario 4 on the chart. Looking back at the 5-minute chart, we can see that we broke and then had an aggressive reclaim of the DR range, leaving this fair value gap. Maybe you don't want to buy here. Maybe you want to see another confirmation. And so price impulses again, takes out these highs, leaves this gap. Now we have the confluence of that daily level, that daily order block level as well. You could be a buyer just above it in this gap. Take a trade with your stop below here, target the midpoint, target this up close candle. And that, to me, is a logical trade to take. Looking at the 2-minute chart, we could see that this is exactly the YouTube model. We have a run below sell side liquidity, which we showed earlier to the left, a displacement above the short-term high, and then a retracement to the fair value gap below 50%. And notice how it respects perfectly the IDR low. It's like, do you think that level might be important? Even though we're not using it to frame a sell trade on this day, this aggressive reclaim, we could, with this context in mind, consider buying at this level. Next example, US 500 5-minute chart. As you can see, we have high impact news on this day. Yes, the DR low has broken. We also know that the DR is less likely to quote unquote work on high impact news days. Also happens to be the day before non-farm payroll. Jumping out to the daily chart, we can see that the DR low break happens right at this daily swing point. This is a previous day low liquidity pool that gets taken out. Notice also we have this down close candle right beneath it. That's where the low of the range is. I've marked out the previous day low. Yes, we get the indication that this high is unlikely to be touched. On the high impact news day, the DR is not as reliable. Now, does that mean you want to take this long? Maybe not. But if you're one of those people that are always looking to sell the 50% of the range, or you see this little up close candle, this would keep you out of a loss. As you can see, price breaks this short-term high. There's probably a model structure break you would see on the 2-minute or 3-minute. And we gap through this level, the previous day's low and the IDR low, and then have a significant rally the rest of the day. So once again, maybe you didn't feel comfortable taking this because we broke the DR low and you didn't want to go against the 80 to 90% probability. That's fine. All I'm suggesting is that this is something to take into consideration. Next example, US 30 5-minute chart. We have a break of the low, also on a high impact news day. The news hit here, and then later in the day, just like the other examples, none of these are at the time of the high impact news. It's just later on in the day. Clearly, we have a clean break below the low. If we zoom out to the 4-hour, we can see that we've generally been bullish, and price has just come down, wicked into this 4-hour fair value gap. If we go to the 60-minute, we can see this down close candle, this bullish order block, the 50% of it. Price taps exactly. Now, if we look back at the 5-minute chart, we can see that this break of the DR low took out this sell side liquidity right at this 4-hour fair value gap. Had a shift, took out this short-term high, created this gap. This could have been an entry. And again, maybe you don't want to target the high because the high is likely to still be in 80 to 90% probability. You get tagged in, and lo and behold, price goes all the way up and does in fact make a new high on this day. But still, I think this would have been a better target. Next example, US 30 5-minute chart. As you can see, we get a confirmation break of the DR high, suggesting that this low is in for the day. We get a retracement back here. Maybe this could have been a long on some other model. And yes, it does yield a decent profit. And what happens after that? We can mark out our swing lows and say, hey, maybe this is going to be a scenario 3 playing out. And this is why I grouped scenario 3 and scenario 4 together in the same video. We mark out the low and we look and see, hey, maybe we will get a sweep. I will look at the lower time frame in just a second, but first, what is important to be aware of is the daily chart, because that DR high break happens right here. Now, if you look at the daily, does this look like an area where you want to be buying? You're right at this resistance level where you have this high taken out by this candle into this gap, and this was the origin of this entire move down. So you're really just buying right at resistance. So if we go back now to the 5-minute chart, again, the point I want to make in this example is that you can't just be so blind and only stay on the 5-minute time frame, in my opinion. Well, you can, but you are likely to deal then with the pain of a day like this. If we break it down even further, let's just say maybe we're still open-minded to a scenario 3-day playing out where we're going to take out this low or this low and maybe see a lower time frame confirmation. If we go to the lower time frame here on the 2-minute, for example, do you really get a decent confirmation here? To me, the displacement is much clearer to the downside from the top. Moving down, notice we've reclaimed the DR high, and we can look to sell this fair value gap right there. And we get tagged in. Jumping out to the 5-minute chart, where do we want our target to be? Probably we could start off with this midpoint of the DR range. We have this gap here. And also, as we know, the probabilities are that we're not going to hit this low. So maybe first target here, second target below this low, and then maybe we close the entire trade at the IDR low. Again, doesn't this look a little bit like a market maker sell model? Also, that 2-minute fair value gap appears as a 5-minute bullish order block. And as you can see, price completely tanks the rest of the day. Also, something I wanted to point out was the very top of this move here lined up exactly with the IDR high from a previous day. I wonder if these levels are important. Next example, US 500 5-minute chart. Also a high impact news day. Later in the day, we can see we get a break above the DR high. If we zoom out, we can see that the DR high break is right here. This is where, yes, this is a 60-minute candle, but this is the 5-minute DR high level. Price breaks above this high, taps into this order block, which took out these buy stops right here. Back at the 5-minute chart, what do we see? We see a break above, fail to go higher, sweep of this short-term high, and a reclaim back into the DR range. Let's say you didn't get that first entry. Using scenario 4, you could take a very reasonable trade. Right here, we get this displacement with this fair value gap, perfectly lined up with the IDR high. And once again, we might not want to target the low because of what the probabilities say, but even a trade like this could give you, I think, about 2 to 3 R pretty easily. And sure enough, price does make a new low. Once again, this was a high impact news day. So is it surprising that the DR didn't quote unquote work that day? And finally, I want to end on this. These are 2 different charts of 2 different assets on 2 different days. Don't they look pretty much identical on the lower time frame? In both cases, we have a break of the DR low, suggesting that the high is not going to be violated for the rest of the day. And on one of these 2, we will see a scenario 3 where price takes a short-term high and sells off for the rest of the day. And one of them is a scenario 4 where we see a break and reclaim back into the DR range without seeing lower prices the rest of the day. Is there some way we could figure out which one is more likely to be a scenario 3 and which one is likely to be a scenario 4? Essentially, which one is more bearish and which one might be more bullish? You may not want to bring a whole bunch of factors or variables into your trading, and I can understand that. But I'm going to show you the daily chart at the start of the trading day before those setups appeared. One of them, the daily chart, looked like this. Here you can see price has been generally bearish, took out these lows right here with strong closes, leaving this imbalance. The prior day had this wick. Sure enough, the following day played out like this. This was that setup, which ended up being scenario 3. And now take a look at the daily chart heading into the day where that other pattern appeared. Here we see the opposite. Price has been generally bullish on the daily chart, taking out these highs, leaving imbalances. A couple days before, price wicked down into the gap, closed above. And then on this day where the setup appeared, it played out like this. Not a crazy move, but if we look back, this was more likely, based on the daily chart, I think, to be a scenario 4 as opposed to a scenario 3. And even though price played out to the upside, the DR rule still worked. This high never was violated on the day. But seeing this as a scenario 4 either got you into a profitable trade or kept you out of taking shorts and avoiding a potential losing trade. The context is almost always more important than the lower time frame pattern, because you can get two patterns that look almost exactly the same, and both of them can play out entirely differently. And now I have one more bonus here, and this is just one I just threw in at the very last second. The question is, does this work in FX? And of course the answer is yes, probably at different probabilities, but I want to look at a scenario in Forex, because literally I just saw this play out with the Aussie yen, and I'm using the ADR. If you don't know what the ADR is, you have to watch TheMas7er's most recent video, his third video on the series. And so what you can use basically for Asia session. Here we have an ADR high break with a few closes above. If we zoom out to the 60-minute chart, we can see that we've taken out a previous day session high into an imbalance. This is where that ADR high break occurred. If we look down, we can see a displacement back down, reclaiming the ADR range, and then price comes in, tags the gap, and then sells off. Just to this low here, this IDR low could have gotten you about 2R, and clearly it kept going. Yes, it does work in Forex. Clearly, this is just one example, obviously, but it's something I'm going to continue to explore myself. And on that note, if you enjoyed this presentation, please let me know in the comments. I hope it lived up to your expectations. Leave a like if you did. If you have any other ideas or things you would want covered in the future, I'm playing around with maybe doing some kind of weekend study sessions, just reviewing all the possible DR, IDR opportunities with these scenarios playing out over the course of a week, just to see, just to do kind of a journal session. I wonder if that would be of interest to people. I think I'm going to do it anyway. So if that's something maybe you would want to see videos of in the future, let me know. I do just think it's interesting to study this stuff. And I'm just also curious, what scenario do you like the most? What resonates with you? What do you feel most comfortable with? What have you seen when you've looked through your own charts? What jumps out? Which scenario do you feel like you see the best on the chart? And with that, I will say thank you for watching, and we will see you in the next video.